I think it's difficult to see exactly what Libra is trying to do at the moment. You know, we've had the whole idea of cryptocurrencies, which has been, initially it was to replace currencies. Now it's more like tokens. It's almost like a securitized version. Here, I suppose they're looking at payments, but there are plenty of payment systems. Payment systems are changing fast. It's difficult to see that Libra is really going to be a real disruptor in that situation, because you can use different currencies to exchange. It's very cheap on the wholesale market to do foreign exchange. The problem is it's very expensive on the retail market, because we've had a number of players that have come in and dominate that market and taken the margin. That's going to go eventually, but I'm not sure that Libra is going to really assist it very much.
Do you see the whole framework breaking down from major players? I mean, you think about credit cards have been very dominant in the space, and already now there's other merchants that have been serious competitors. In that panel we heard yesterday about all the different players, from Apple Pay to even like a Walmart Pay service. If major retailers can all embark upon their own payment system as well, where does it even leave a challenger like Facebook and Libra?
Well, that's right. I mean, if the main competitors like MasterCard and Visa are likely to be disintermediated, then you wonder why another competitor is coming into the market. I mean, there are multi-currency accounts now in banks, certainly in Asia, where people do a lot of multi-currency work, and you have a debit card that activates on each of those currencies, so you pay no cost. So, I might come to the UK and pay in pounds off my account that's somewhere else in the world. So already the payments are being, the major intermediaries are being disintermediated by technology.
Let's look at the other side of the coin. And we had Stefan Ingves, who is the governor of the Riksbank, the Swedish central bank, sitting here just a couple of days ago talking about this issue. Mark Carney again. We know the central banks are nervous, and they have every right to be nervous. Sovereigns have every right to be nervous. In fact, it became such a big issue at the G7 finance ministers and central bankers meeting in Chantilly this year that was the one thing that they all agreed on, to work on this and prevent the private sector from having any money printing ability. That's kind of the impression I got as well. They are right to be nervous, given what they've done with the monetary system, aren't they?
Well, have they dealt it sensibly and responsibly themselves? And then you have to say, well, would a new currency system work? I mean, I think the central banks are concerned about large amounts of money going into cryptocurrencies and maybe just disappearing. At least the thing is, with a central bank-backed currency, it is backed by the country. I mean, in theory, it's supposed to be backed by the taxation of the country, so there is some backing. But it's nice to think that there's some kind of crowd-funded backing of currency out there.
Backing. What countries are you talking about? I mean, dare I say it? Well, if I go down the list of what's backing up some of these currencies and these economies, I don't want to look too carefully, because I'm seeing some pretty big debts. Well,
now you're going into the real crux of the problem. I mean, there's economic theory is one thing, that central bank's currency is backed by the country, but then you can only look at Argentina to say that that doesn't necessarily work.
Argentina's probably not the best. Well, no, it's a good example of your concerns.
Yeah, but there are lots of concerns out there. I mean, debt is the big factor out there that nobody's really got a handle on. I mean, it's extraordinary that the IMF conference isn't really talking about it. Indeed, many times
well, it is. The IMF suddenly decided we need to be worried about financial risk-taking because of, wait for the big headline, low interest rates. But my understanding was that was the whole point, to push people into riskier assets, was what the IMF endorsed the central bank action to be.
But it's great.
The IMF has endorsed the central bank action many times to stimulate the world economy.
Yeah, but as usual, they're stuck on the same crack in the record, aren't they? I mean, basically, when you're looking at bringing an economy out of recession, as we were in 2010, 11, 12, yes, by all means, have low interest rates. But what we've had is an extended period of very low interest rates, where people have got more and more in debt, and all the figures look at this. And you have to say, at the end of the day, what's going to happen. And it seemed to me that the IMF warning was actually looking at maybe liquidity shrinking for a reason. People suddenly worried that they've got to call in that debt, and we have a big shrinkage of liquidity, a credit crunch, and further recession.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.